UnitedHealth's revenue grew 20% over 2 years. Its net income fell 46% over the same 2 years. My call is that Optum Rx, the pharmacy benefit manager inside UnitedHealth, passes 40% of the whole company's operating earnings for 2026 at 60% odds. Last year it was 38%, and 2 years ago it was 16%. Not because the PBM is growing spectacularly, because every other segment fell, and it didn't. The insurance business has stopped working. The pharmacy business hasn't. Most coverage of this industry assumes insurers extract 20 or 30 cents on the premium dollar. UnitedHealth's net earnings margin last year was 2.7% on $448 billion of revenue. They keep 2 to 4 cents and less every year. Meanwhile, the part under the most political pressure is the only part still earning. And here's my disagreement with the measure attached. This group is priced as though the last 2 years were a bad cycle that already ended. UnitedHealth trades at 25 times trailing earnings that fell 46%. Centene lost $7.6 billion at the operating line and sits 6% below its 52-week high. Nothing in those prices says the market has accepted that anything structural happened. Look at the operating margins. UnitedHealth went 8.7% to 4.2%, CVS 3.8% to 1.2%. Cigna went 4.4% to 3.3%, Elevance 5% to 3.6%, Humana 3.8% to 2.1%, and Centene went from 2.1% to negative 4.4%, which on $175 billion of revenue is a $7.6 billion operating loss. Every one of those 6 grew revenue over the same period by between 12 and 41%. Everyone earned a lower margin on it. UnitedHealth's medical care ratio, medical cost divided by premium revenues, its own definition, went 83.2%, 85.5%, then 89.1%, up 5.9 points in 2 years, while its operating margin fell 4.5, close to 1 for 1. Cigna's did the same thing more gently, 81.3%, 83.2%, 84.4%. If 83 cents of the premium dollar goes out as medical cost and roughly 14 more goes to running the company, you're keeping about 3. Thin by construction. Push the medical cost to 89 cents and there's nothing left to absorb it. Premiums are priced a year in advance, so a cost that lands above the assumption isn't recovered until the next cycle, if then. That's why the same shock hits 6 companies at once. They were all pricing against assumptions that turned out low in the same year in the same direction. If you want the segment tables read properly rather than the headline, subscribe. The next teardown is where drug pricing actually lands. Diluted earnings per share went $23.86, then $15.51, then $13.23. Return on equity fell from 27% to 12.8%, and the net earnings margin went from 6% to 2.7%. The tax rate tells you how thin it got. 20.5% in 2023, 24.1% in 2024, then 12.9% last year, and net income still fell. $448 billion of revenue, 2.7 cents of net earnings on the dollar. UnitedHealthcare, the insurance arm, earned $9.4 billion last year against $16.4 in 2023. That's down 43%. Its segment margin fell from 5.8% to 2.7%, which on that revenue base is the difference between a business and an administrative overhead. Its revenue over those 2 years grew 23%, from $281 billion to $345. More premium, less profit. Optum Health, the care delivery arm, went from $6.6 billion of operating earnings to a $278 million loss. Optum Insight fell from $4.3 billion to $2.6. Optum Rx went from $5.1 billion to $7.2, up 41%. Across the 2 years, everything else in the company was falling. Optum Rx was 15.8% of UnitedHealth's operating earnings in 2023. Last year, 37.9%. It didn't triple. It grew 41%, which is good, but not extraordinary. The denominator collapsed around it. A health insurer with a pharmacy business attached is becoming, in profit terms, a pharmacy business with a health insurer attached. Neither company reports that ratio. You have to build it out of the segment table yourself, and almost nobody does. Run the same arithmetic on CVS, and Caremark comes out at 49.5% of adjusted operating income. 2 of the largest healthcare companies in America now make roughly half their profit in a segment that neither of them leads with. CVS's insurance arm, healthcare benefits, earned $5.58 billion of adjusted operating income in 2023. In 2024, $307 million, a 94% collapse in 1 year, recovering only to $2.94 billion last year. Caremark, the pharmacy benefit manager, earned $7.31 billion, then $7.24, then $7.15. It moved about 2% across 2 years while everything around it moved by tens of percent. Caremark is now 49.5% of CVS's adjusted operating income. Evernorth, which contains Express Scripts, did $153 billion of adjusted revenue in 2023 and $235 billion last year. Cigna Healthcare, the insurance side, did $51 billion in 2023 and $47 last year, down 11% in 2025. Evernorth is now about 86% of Cigna's adjusted revenue. I didn't retrieve the segment income split, so I won't put a margin on it. The mix alone makes the point. The pharmacy benefit manager doesn't take the risk that a population gets sicker than expected. It processes claims, negotiates with manufacturers, runs a formulary, and takes a spread on volume. The same work whether the population it serves turns out healthy or catastrophic. That's a toll booth. When medical costs surprise to the upside, the insurer eats it. The administrator largely doesn't. That's the entire structural difference. One segment lost 94% of its earnings in 12 months. The one beside it moved 2%. That's not skill, it's a different risk position. The most politically exposed business in American healthcare is now the profit engine of the largest companies in it. 38% of UnitedHealth's operating earnings, about half of CVS's adjusted operating income. Here's the mechanism, and it's the part one don't think the price is carrying. A pharmacy benefit manager's earnings don't come from volume. They come from a spread it keeps, the gap between what it negotiates and what it passes through, which means that line can be compressed without a single prescription changing hands. Revenue wouldn't move at all. Earnings would, and it would land at the worst possible moment because there's nothing underneath it anymore. UnitedHealthcare's segment margin is 2.7%. CVS's insurance arm earned $307 million in 2024 on a business that made $5.58 billion the year before. 2 years ago, a squeeze on the pharmacy line would have been absorbed by the insurance side. Today, the insurance side is the reason the pharmacy line matters. So here's the threshold. It's a number UnitedHealth prints every February. Optum Rx operating earnings, $7.19 billion last year. If that figure ever falls year over year, the last line holding this group up stopped holding. This sector is valued on a narrative about profitability that its own filings contradict. The real question isn't whether insurers make too much. At 1 to 4 cents on the dollar, that question is answered. It's whether the one part still making money can keep it. The thesis lives in the pharmacy benefit line rather than the insurers as a whole. It's the only line that held through a shock that took 40 to 80% out of everything around it. The counterweight is that medical cost ratios are cyclical. Premiums reprice annually, and 2 good pricing years would pull UnitedHealthcare's margin back toward 5% and make this look like a description of one bad cycle. That's genuinely possible, and it's what the share prices already assume. Every stock in this group is still within 18% of its 52-week high, after earnings fell 40 to 80%. Centene posted a $7.6 billion operating loss. It's 6% off its high. Through 2027, most likely it's 60%. Medical cost ratios stabilize without fully reverting. Insurance margins recover partway, and the pharmacy line keeps carrying an outsized share. Better, but not back to 2023. The call stands. Optum Rx above 40% of UnitedHealth's operating earnings for 2026 at 60% odds, settled by the segment table in February. Second order, and the one that matters for the whole group. UnitedHealth's medical care ratio below 88% for 2026 at 55% odds because every other line depends on it. 3. Break thresholds. The medical care ratio, 89.1%, above 90, and the repricing isn't working. UnitedHealthcare's segment margin, 2.7%, above 4.5, and the insurance business is genuinely healing. And Optum Rx's earnings in dollars, $7.19 billion. The whole thesis assumes that line holds. Catalysts up, a pricing cycle that finally catches the cost trend, or membership mix shifting toward better price business. Down, another year of cost trend above assumption, or anything that compresses the pharmacy line while insurance is still weak. Upstream, this pulls hospital systems, drug manufacturers, and every provider negotiating rates against these companies. Downstream, it's premiums and the employers and members who pay them. What changes my mind? UnitedHealthcare's segment margin back above 4.5%, or Optum Rx earnings falling year over year. The first says the cycle turned. The second says the last safe line wasn't safe. I'm Big Z. Follow me. See you in the next deep dive.